Okay, welcome back, and this is section 7 of chapter 8. So we're almost to the end. So now we're going to talk about the cost of home ownership. So we're going to talk about amortization of a home mortgage. And so this is not going to take long, but this is going to be important for you to understand how this works, okay, because it's going to save you a lot of money. Okay, so we're going to talk about how to compute the monthly payment and interest costs for a mortgage, how to prepare a partial loan amortization schedule, solve problems involving what you can afford to spend for a mortgage, and 4, how to understand the pros and cons of renting versus buying. So here are the terminology. So this is some of the stuff that you're going to need to understand. So a mortgage is a long-term loan for the purpose of buying a house. Okay. Now, the thing is that a mortgage involves regular payments, okay, over a fixed number of years. So this is an installment loan. Okay. So a mortgage is a long-term loan for the purposes of buying a home, specifically buying a home. And by the way, the word mortgage comes from medieval times. It actually comes from the medieval times, and it actually comes from two words from the Greek. Mort, that comes from the Greek word for death, and gagis, which comes from the Greek word that for a grip. So literally speaking, mortgages means death grip. So I think some of you might find that humorous, but yeah, some of us who are homeowners totally get that. It does feel like a death grip sometimes, especially when you see how much money you pay for a mortgage versus compared to the value of the home. Your jaw will drop. So anyway, so the down payment is the portion of the sale price of the home that the buyer initially pays to the seller. Okay. Then the amount of the mortgage is what's left over. So what you're financing for the house. The mortgage is the amount that you're financing to get a house. Okay, so it's the difference between the sale price and the amount of the down payment. Now, some companies called mortgage brokers offer to find you a mortgage lender willing to take you to make you a loan. So mortgage brokers basically shop around and they do the legwork and try to find a lender that's willing to give you a loan. Okay. Now there are two types of mortgages that we're going to talk about. One is a fixed rate mortgage, which means that you're making the same monthly payment over and over time because your interest is the same. It's a fixed rate, so your rate is fixed. So every month your mortgage is the same. Then there are variable rate mortgages known as ARMs or adjustable rate mortgages. Now adjustable rate mortgages, your payments will change from time to time depending on changes in the interest rate. Now, most ARMs will have a fixed period, which means usually the first 2 to 3 years you'll pay a fixed low rate. And then what happens is after that fixed period, the rate will start to change. It'll become a variable rate. And so that means the rate will go up, and usually, depending on the contract, it could go up at a maximum of 1% a year. And so adjustable rate mortgages are very dangerous to get into. And so usually people with bad credit or subpar credit are usually the ones that get a variable rate mortgage because they can't get into a fixed rate mortgage because you usually have to have better credit to get a fixed rate mortgage. Now, it's okay to get an ARM as long as you keep in mind that you've got to improve your credit over that fixed rate period so that before the fixed rate period ends, you can convert it or refinance into a conventional mortgage or a fixed rate mortgage. Okay, so again, those are the two types of mortgages that we're going to talk about. Now, so most lending institutions require the buyer to pay one or more points at the time of closing. That is the time at which the mortgage begins. So when you go to the closing, that's where you sign all the documents and everything's good, and they've checked everything, and everything's great, and all you have to do is go there and with your check, okay, and we'll talk about that, and just sign all the papers, okay? So a point is a one-time charge that equals 1% of the loan amount, okay? So if you pay 1 point, it's 1% of your loan amount. If it's 2 points, it's 2% of your loan amount, okay? For example, 2 points means the buyer will pay 2% of the loan amount at the closing, which means you'll have to have a separate check just for this amount, okay? Now, a document called the Truth in Lending Disclosure Statement is usually given to you before the closing. It's usually given to you at the beginning of the process that basically tells you, okay, here are all the estimates of closing costs, the loan amount, interest rates, yada, 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 yada. Okay, and it shows the buyer the APR for the mortgage, the annual percentage rate. In addition, lending institutions can require that part of the monthly payment be deposited into an escrow account. So that's also a possibility. Sometimes they don't require it. Okay, I know for my wife and I, we did our own. We paid our own taxes, insurance. So escrow is an account that's set aside by your mortgage company, by the servicer, into a separate account that is used by the mortgage company to pay your taxes and insurance every year. So you pay a higher monthly payment, but the part of that payment is going to pay for your taxes and insurance. Now, if your company doesn't require you to do that, then you only pay your mortgage payment, your principal interest payment, but then you have to set aside money every month to pay your taxes and insurance at the end of the year. And so it's, again, most insurance company, not insurance companies, most mortgage services, most mortgage companies, banks will require an escrow account. Okay, some don't. Okay, for a number of years, my wife and I did our own, and then when we refinanced, we had to do that. I preferred doing it myself, but again, I'd rather stick it into my account where I'm earning interest instead of them having it and sticking it in their account and them earning interest. That's my take. Okay, so now here is the payment amount. Now notice this is the same formula, right, as the installment loan. Okay, so this is the same formula for the fixed installment loans. Okay, so the regular payment amount, PMT, required to repay the loan of P dollars in N times per year over T years with an annual interest rate of R. And so this is what we're going to use. So now, the price of a home, let's say, is $195,000. The bank requires 10% down on the house and 2 points at the time of closing. The cost of the home is financed for 30 years. Okay, and it's a fixed rate mortgage at 7.5%. Okay, so we want to find the required down payment. Well, it's just 10% of this, which is $19,500. So that's the down payment. Find the amount of the mortgage. Well, that's going to be $195,000 minus the $19,500. Okay, and then how much must be paid for the 2 points at closing? Well, what is the 19,000? So 195 minus 19,500. So let's say 20,000. So that's 17. So if we do 20,000, 175,500. So it'll be, yeah, 175,500. So we're going to pay 2% of that. Okay, so we're going to take 2% of this, and that's going to be the number, the amount of the 2 points. And so this is what we're going to have to pay at closing extra. So this will be a separate check that we'll have to bring at closing to pay for the points. Okay, let's see what else. Let's see. So basically you'll have two checks. You'll have one check that will be paid, which will be $19,500. Okay, that'll be paid to the seller. That's the 20% down. And then you'll have a separate check that will pay to the lending institution, or whoever is doing the closing is $35.10. So there'll be two separate checks. Now D, what was D? D was find the monthly payment excluding escrow and taxes. So again, this payment calculator only gives you the principal interest payment. Okay, so it doesn't include taxes and insurance. That's completely separate. And so if we use the payment formula, we find that our monthly payment is going to be approximately $12,027 per month, and that's the principal interest payment. Okay. And then E is find the total interest paid over 30 years. So what we're going to do is we're going to take our payment, and we're paying 12 payments per year for 30 years. So that's 360 payments of what? 1,227. So how many total payments, or what are the total of the payments? Well, for 30 years, so we're going to do 1,227 times 12. So there's 12 times 30, so that's 360. So 1,227 times 360. So how much are you going to pay over 30 years for this $195,000 home? Or in fact, where you're paying $175,500 for? $266,220 is what you're paying for this house over 30 years. And how much was the house worth when you bought it? 170 or 195,000. Right? Now this is now that's what you're paying, but you also paid the 19,500 down on the house. Okay, so you're basically paying what? 200. You paid 280, 285,720 for the house when it's all said and done. So now, when a loan is paid off through a series of regular payments like an installment loan, it is said to be amortized. Amortized means killed off, right? You're killing off the loan. Now, what this means is that although each payment is the same, with each successive payment, the interest portion decreases and the principal portion increases. So what happens is at the very beginning of a loan, the vast majority of your payment that you're paying every month is all virtually interest and a little bit of principal. So you're not paying down very much of the loan at the beginning. But as time goes on, every time you make a payment, you pay a little bit more principal. So the amount of the payment that's going towards interest decreases over time, and therefore the amount going towards principal increases over time. Now, there's a document that shows how your payments and the principal interest changes, and that's called the loan amortization schedule. And you can actually get these on Excel. You can create these yourself on Excel, and they have all kinds of templates. But you get an amortization schedule with your loan paperwork. So now, if you wanted to find what this loan amortization looks like, you can do a partial table, and you're going to want to make sure you know how to do this. This is going to be you're going to be tested on this, either quizzes or exams. So it says prepare a loan amortization schedule for the first 2 months of a mortgage loan shown in the following table. Now, the one thing you're going to notice is that the calculation for each month is just a simple interest calculation. Okay? So what you do is your first payment is $1,357.50. Okay? Your interest payment, your principal payment, and then you'll have the balance afterwards. Okay. Now, how do we fill out the table? Well, the first thing you're going to do is you find out the amount of interest. Well, what's the interest amount of your mortgage? Well, it's 9.5% of $130,000. That's going to be your interest portion of the payment. And then you subtract that interest part from the monthly payment, and that's going to give you your principal amount. And then you subtract off that principal amount from the balance. So let's go through it. Okay. So the interest for the first month is just a regular simple interest loan. So it's $130,000 times the 9.5%, and then it's 1/12 of a year. Okay, don't forget, this is not a full year. It's monthly payments. So the amount of time is 1/12 of a year. Okay, so then your interest, look at that, your interest is $1,029.17. Okay, what was the interest? What was the payment? Look at that, $1,357.50. Okay, so the vast majority is interest. So now to find your principal payment, you take your monthly payment, subtract off the interest payment, and this is the amount that's going towards principal. So now to find your remaining balance, your balance of your loan, you take your principal balance, which is the $130,000 that you started with, minus your principal payment, which is $328.33, and now this is your new balance. And so this is the amount that you're going to take interest on for the second month. And so now for the second month, you're going to now take your new balance times the interest rate times 1/12, and now here's your new interest payment. Notice that it went down a little bit, $129.17 down to $126.57. Not a whole lot, right? So now you subtract again, and now here's your new principal amount. And then to find your new balance, then you subtract your current balance, you subtract off the principal payment, and now here's your new balance going into the third month. And you do this over and over and over and over again, 360 times. And so here's what an amortization schedule may look like. Okay. And you could do this on an Excel spreadsheet very easy. There's lots of Excel spreadsheets out there that help you do this with just a click of a button. Okay, so now one of the biggest things is, what house can I afford? How much of a house can I afford? Okay, so here's the bottom line for most financial advisors. You do not want to spend more than 28% of your gross monthly income. I've heard 25%. Okay, but it's definitely no more than 28% of your gross monthly income for your mortgage payment. So if you take your gross monthly income and you take 28% of that, you do not want to have a mortgage payment larger than that. Okay? Or spend no more than 36% of your gross monthly income for your total monthly debt, including mortgage payments, car payments, credit card bills, student loans, and medical debt. So if you take all of your monthly debts, you do not want, including your mortgage, you do not want that amount to be more than 36% of your gross monthly income. So either one of these two rules is what you want to go by. Okay, if you go above that, you cannot afford the house, or you are buying too much house, and your chances of being foreclosed on and losing the house goes up. Okay, so here's a table that shows you some of the ideas. Okay, so here's based on the 28%, okay, for your mortgage, and here's based on 36% of your total debt obligations or credit obligations. Okay. Suppose that your gross income is your gross annual income is $25,000. Okay. What is the maximum amount you should spend each month on a mortgage payment? Okay. What is the maximum amount you should spend each month for total credit obligations? And see, what if your monthly mortgage payment is 80% of your maximum amount you can afford? What is the maximum amount you should spend each month for all other debt? So again, if your monthly mortgage payment is 80% of the maximum amount you can afford, what is the maximum amount you should spend each month for all other debt? Okay, we're going to round all these to the nearest dollar. Okay, so the first one says, what is the maximum amount you should spend each month on a mortgage payment? Okay, so this is $25,000 a year. What is the maximum amount on a mortgage payment? So again, it's no more than what? No more than 28% of your monthly gross income. So if you take 25,000 divided by 12, this is your monthly gross income. So if you take 28% of that, this is your monthly mortgage payment. You should not spend any more than that amount of money on your mortgage. Okay, and this is principal interest. We're only talking about principal interest here. Okay, now, how much should I spend on total debt? Well, that's going to be 36% of your monthly income. So I should only spend at most, including the mortgage, on all debt, all my debt obligations, $750 a month of my income. So no more than 36% equals approximately $750 a month. Okay, so now the next one says, let's say my mortgage is 80%. Okay, so let's go back. If your monthly mortgage payment is 80% of the maximum amount you can afford. So what was the maximum amount you can afford? $583. Let's say that I got a mortgage and it actually turns out to be 80% of this. Okay, so we first have to figure out what 80% of this is, and then we're going to subtract that from this amount, which is the total amount of all of our debt obligations, including the mortgage. And that will tell us what we can pay on all other debts. So if we find this out, okay, 80% of 583 is 466. So that's that's our mortgage payment. Okay, that's the mortgage payment that they got. So now we're going to take this 466 and we're subtract it from 750. So that means $284 is what we should not exceed for all of our other debt obligations. Credit cards, student loans, other things. Okay. Now, benefits of renting. Okay, so here's the benefits of renting. No down payment or points are required. You generally have a security deposit that is returned at the end of your lease, and you better be aware that most landlords try to keep that. So make sure you clean the apartment and you don't put any holes in the walls, and you do whatever you can, because landlords are looking for any way to keep your deposit. Okay, very mobile. You can easily relocate if you end up breaking the lease, or after your lease you can move. You can move as often as you want. Okay, again, look at your lease permit. Look at your lease agreement. There may be penalties for leaving early. Does not tie up hundreds of thousands of dollars that might be invested more safely and lucratively elsewhere. Okay, so it's not like you've got a mortgage, right? Most financial advisors agree that you should buy a home because you want to live in it, not because you want to fund your retirement. And I completely agree with that. A house is not a retirement. It's not an asset. And if you have any financial advisor or any accountant that tells you otherwise, they're dummies, and find a new one. Does not clutter what you can afford for your total monthly debt with mortgage payments. may involve lower monthly expenses. You pay rent, whereas a homeowner pays mortgage, taxes, insurance, and so on. Now, one thing that I would also say that you would need to have is renter's insurance. Okay, it's very cheap, but it protects you from things like a fire in the apartment complex. Let's say your neighbor falls asleep smoking and his apartment catches on fire and your apartment gets burned down. Well, if you don't have renter's insurance, you lose everything. So renter's insurance is very cheap and protects you from loss of things like that. Can provide amenities like a swimming pool, tennis courts, and health clubs. Of course, you're going to pay a higher rent for that. Avoids the risk of falling housing prices. Does not require home repair, maintenance, and groundskeeping. There's no property taxes. Generally less costly than buying a home when staying in it for fewer than 3 years. So this is short term. Short term renting is a better option. Okay? If you're not looking to stay somewhere for a long period of time, if you're not looking to settle down and you're going to be traveling and you're then renting usually is the better option. Okay? Now, benefits of home ownership: peace of mind and stability, provide significant tax advantages. I would argue with the word significant, including deduction of mortgage insurance and property taxes. There is no chance of rent increasing over time. Okay, that is a downer for rent. Rent can be increased every year. Allows for freedom to remodel, landscape, and redecorate. It's your land. You can do with it whatever you want within reason. You can build up equity in your house. So basically the difference between what the home's value is and what you owe on the mortgage. So when you pay off your house, now you have a house that's worth something. It has equity, it has value. Okay, it becomes an asset. Okay. The possibility of home appreciation is potentially a source of cash in the form of equity loans, which bad. Don't, equity loans, avoid debt. Now, also, when looking at 7-year time frames, the total cost of renting, okay, monthly rent, renter's insurance, loss of potential interest on a security deposit, etc., is more than twice the total cost of buying a home for owners who itemize their tax deductions. Okay, so again, long-term owning is better. Short-term, 3 years or less, renting is better. Okay, that's the end of the video. So again, make sure you review, practice, and come to class prepared. What that means is watch this video before class and come prepared to work and ask questions, and let's get right down to it. Okay, have a great day, and I'll see you later.